In fact, the 50% additional tariff is applicable on roughly 55% of our export. 45% exports of the product like pharma, mobile phone, petroleum, they still continue at zero duty, and some of the product like steel, aluminum, copper, they face a uniform tariff of 50%, so we have the level playing field. The 55% of my export is definitely impacted. The good thing is that with the front loading of exports, probably the export for first 6 months has already been made. So under danger is an export of around $25 to $25 billion, but we expect that some of that exports will continue. Some of the exports which are being made to the leading brands, where the brands have the enough cushion to pay for the duty, will continue. Some of the companies, the global brands, are looking into shifting the export from India instead of US to some other country. That may go, of course, that may take a hit for our export to the US, but from export to other country may go up. But in the short term, we should be ready to take some hit also. And the unfortunate part is that from MSME's perspective, who hardly have the deep pocket, we are little concerned with that. It is not just the loss of business. We have to see what will be its impact on the liquidity of the exporters, because probably if the exporters' liquidity is there, there will not be an NPA, and once the situation improves, they will continue to be in business. So as of now, our priority is that we should ease the liquidity to the exporters, because if they have the liquidity, if some moratorium in the loan payment may be given to them, if some collateral-free lending can flow to them, some enhancement of limit happens, so they can tide over their current problem. Our other priority is for the workers, because if the business is not there, particularly for the companies who are having more exposure into the US market, we have to see how the industry retain the worker. We are also trying to get a feel from the industry how we can use the lean period for upskilling or reskilling of the worker. We will be also requesting the government if the necessary fund can be allocated so that this lean period can be used for reskilling. It is very important that worker remains on the payroll of the company, because this is a temporary problem. The situation will improve, and if workers can be upskilled in this period, they will turn out to a very productive asset when the business moves up. So the problem is temporary, and therefore we should look into in what best way we can mitigate the challenges for the industry.
As we stand today, the additional tariffs of 25% have kicked in today. That is the 27th of August 2025. So as the situation stands, today the Indian merchandise is subject to 50% tariff on exports to the United States market, as against the original 10% before start of the tariff situation. As we have seen, it is the US consumer who has to bear this brunt of all these additional tariffs, and the Indian industry will remain largely insulated. As in the case of rice, US is one of the major markets for Indian rice, wherein US is importing about 250,000 metric tons of rice every year, valued at roughly 3,100 crores. As we have seen, a 10-pound bag of basmati rice, which was previously being sold at 17 USD per bag, has now increased to 20 USD per bag. There is largely a tendency amongst distributors to jack up prices whenever such situation arises, in spite of availability of sufficient stocks. There is a broader consensus within the industry, as we have seen with examples of previous countries imposing sudden tariffs like Nigeria and Kenya, who have also in the past suddenly imposed tariffs on their domestic imports. However, the consumer does not do a favor by importing Indian goods. They only import what they need and what they require. So it is ultimately, in terms of food, we have largely seen that the consumer does not change to alternative food habits, and they are willing to pay the higher prices. And once there is an acceptance of these higher prices in the domestic market, it is the exporters who in the long term benefit, as when these tariffs go away or the local government is forced to roll back these tariffs, the prices remain high and exporters are able to sell at a higher price. Recently we have seen that this deadline was set at 27th of August for the additional 25% to kick in. So all the exporters, to avoid this situation, had pushed more as much as possible in the last 1.5 months. So we had seen a substantial increase in shipments from India in the last 1 to 2 months. So coming into the next quarter, till November and December, we do not anticipate any significant drop in Indian exports. And once we kick into the low period, which is the festival season during December and January, the exports normally drop. So till January and February, we do not see a significant drop in Indian exports, and Indian exports are largely expected to continue at normal pace. This is also a pivot time for Indian exporters to expand into new markets. As we have seen recently with the high-level delegation of Philippines which visited India, they committed to increase food imports from India. Philippines is importing roughly 2.3 million tons of rice every year, which is 90% more than what US is importing annually. So in a bid to move away from China, the Philippines has committed to increase imports from India. Hence, we do not, and the industry does not anticipate any significant loss in exports, and our exports will largely remain the same, and we expect that this year the exports may even rise. So in the end, I would like to say that it is the US consumer who will bear the brunt of these additional tariffs.